housing, chief economist, and dad of 9. Just, here on Thursday afternoon, ready to partake in another housing debrief and spread some of the wisdom that we're finding in looking at all the data and the stats. But without further ado, let's go ahead and get started with our housing debrief. And here we go. I, of course, want to invite everybody to like and subscribe. Please, if you're at Facebook, navigate over to youtube.com and look for reports on housing. We broadcast there live. That's where I'd like for people to subscribe and to get the algorithms up so that we get in front of more people so we can help educate consumers, properly set expectations for people so that they can make great decisions on behalf of their families. So anyways, got to, of course, have some fun photos to start everything off. And listing agents are returning buyers agents. Calls again. How about that? Yeah, that shows you there's a bit of a shift in the market. That's for sure. How about millennials? Come on, collapse. Yeah, this is where a lot of millennials feel like they missed out on the housing market because there's a lot of first-time home buyers, and where we're getting a lot of noise, people that are waiting for the market to turn so that they can go ahead and pounce on the market. But that's not necessarily going to happen. But without further ado, as housing slows, when will prices drop? And that's the big thing. I keep on getting this over and over again. People always ask, even after my presentations, and I show where we're at, and I talk about how we're not going to have a crash and how we're going to go from a very hot market to just a slight seller's market. People keep on asking, so when are prices going to come down? And it doesn't help that we're getting a lot of noise out there. There's plenty of it. Home prices have begun falling. Here are the cities where they're going down. And this is from Realtor.com. And they actually highlighted Los Angeles as one of those. And I just saw it was picked up by Orange County paper that talked a little bit about how in Los Angeles price of, I can tell you this for sure. Knowing where supply and demand is throughout Southern California and all the markets that I track, Nevada, Vegas, as well as Phoenix, as well as the Bay Area, with the mismatch in how low supply is and where demand is, even if demand is softened a little bit, it is still, we are going at a very fast speed. Values are still up. There are not prices coming down locally. So I wanted to throw that out there. Also, we're in a historically overvalued housing market, and these cities could see home prices drop 10%, Moody says, and they've got this highlight all over the place. And of course, Southern California is all the nasty colors of way overvalued, as well as, of course, the Bay Area. Another housing bubble, we're skating close to one, says Realtor.com Economist. I've read a lot of what this person has had to say, and I just don't necessarily match up with them. I don't think that they're looking at the same economic models that we are, the real estate economic models, as well as the overall economy throughout the United States. When I see a lot of these things, of course, makes me a little bit upset. And the reason for that is just because I have passion for what I do, and I want to properly set expectations of everybody out there, buyers, sellers, consumers, everybody within the real estate land, so that they understand exactly where we're at. It's like when we went into the pandemic, I was telling everybody, you know what, this market's going to be hot. Again, we're still going to have appreciation by the end of 2020. And people thought I was crazy, but of course we adapted and we hit it out of the park. We had a real hard time with supply, and we had plenty of demand with 17 record low interest rates. But I have been talking about how there are cracks in the market. I have been talking about slowdowns. So I understand where people can get confused out there. And basically, what we're doing right now, or what we have been doing, is we've been going so fast that the speedometer is at the very end. So it's like we are going like 250 miles per hour. Our speedometer can't even track how fast we're going. We're just going way too insanely fast. And now what I've referred to is with these higher rates, as long as we have 4.5% plus rates with duration, it's going to shift. And it's going to shift to, like, let's say 70 miles per hour. So if we're going at 250 and we go to 70 miles per hour, I want you to understand that is going from a very, very ridiculously insane hot seller's market to just a regular old seller's market. Home price appreciation has been crazy. That's why when you're going 250 miles per hour or whatever speed we're going at insanity, we have been going up at about 20% clip per year. So that 20% annual clip is just overheated. It is what I call out of control. Last year we called it unhealthy. This year out of control. But it's going to move from a 20% to probably about 5% appreciation. And understand that at 5% appreciation, it's not even keeping up with inflation. So it is going to slow down. When in real terms, it's actually would be negative, but its prices are still going to go up. It's not like I'm saying we're going to be going in reverse. We're going from 150, like I said, all the way down to 70 miles per hour, but we're definitely not going backwards. We're not going in reverse. We're not shedding prices. And I'll explain why. There's a definitive missing ingredient to our housing market right now, which you need in order for values to come down, and that is supply. And I know you're this is where I lose a lot of people. They go, but Stephen, it's slowing down. But we are missing a valuable ingredient, a very, very key ingredient for this market to really adequately slow to the point where it actually goes negative and we have price declines. That is called supply. It is supply that we're missing. We do not have enough homes on the market. You can still see it. We do have more open houses finally on the weekends, just a few. But if I remember way back prior to the Great Recession, we had or during the Great Recession and just prior to it, we had tons of open house signs. This is where inventory is at. Last week, we were at 16,837. That was up 15% or up 2,250 in a 2-week period of time. Now, understand that was the largest increase, 2-week increase since January of 2014. Long time. It's the first time that homes, there are more homes on the market than last year. So there's more homes than the prior years, the first time since August of 2019. So that's key. And it's starting to happen in more and more markets. Not all markets are there yet, but they're all getting to that. And they will get there within the next couple weeks to the next month. And we're going to be doing that nationally too, where there will be more homes in the market than last year. Because this year we hit an all-time bottom, but because things are slowing down, we're starting to see more homes come on the market. It is a new trend that we have not seen since all the way back in 2019. You can't even remember back to 2019 prior to the pandemic. Last year, we were at 15,983 at this time. That's actually 5% less than where we are today, 854, so almost 1,000 homes less. And the three-year average prior to COVID, that's 20 through 2019. I like to look at that period prior because that's when things were more normal. There were 37,000, over 37,000 homes on the market, which is 122% high. So let's see. So today we're actually at 17,500. Only went up 4% in the last week. So we were going up at a big clip, and now it's kind of slowed down a little bit. And that's because we actually got a little bit more demand within the last 2 weeks, which is something new. And if you look at this, where's the inventory headed? So the inventory is definitely headed up, with which, like I said, we haven't not seen this kind of a head up since 2019, where we actually had a bit of an increase, because even 2019 was kind of flat. You even have to go prior to that to even remember when we were actually adding enough homes on the market. So this is where we're going to go. We're going to pass last year. We're even going to probably pass 2020 and end up somewhere around 30,000 homes on the market. So remember that, 30,000 by the end of the year. And that's where we'll peak. Typically we peak in the summer between July to the about the third week of August, because after that, you don't place your home on the market. That's when kids go back to school. So you don't want to place your homes on the market, and everything starts to slow down. However, because we are dealing with a different kind of market with rising rates, we're going to have a buildup of inventory that does not peak until the fall. And that buildup is all because of this. We have these higher rates. Now, I took this as of today. This is actually, today was the highest that I had seen rates in, following it on a daily basis from Mortgage News Daily. And it's at 5.62%. And when I went backwards, last time we saw rates this high was November of 2008. So long time ago did we see rates this high. So, and this is that chart. I like to show this over and over again because I'm going to update this over time. But I want everybody to understand this is what's happening. The dotted yellow line are interest rates so far this year. Largest increase since 1994 in interest rates. And so a big jump, and we did it really fast, and it's still continuing to go up. In 2013 and 2018, that 2013 that we had rise in interest rates. I'm showing you 2013. That's the dotted green line, and you can see we had inventory start at 25,000 and make our way towards 40,000. This time around, we are starting at a much lower number. We're at 15,000 right now, and I think we're still going to try to make our way towards 40,000. We'll see how high we can get, but understand that even at 40,000, that's not enough homes on the market. But what happens is when you get this rise in rates, you get demand start to soften, and not everybody's willing to purchase everything that's on the market. And so you get inventory that rises. Inventory rising, demand dropping, you get it at market times. The length of time it takes to place your home into escrow after placing it on the market starts to grow, and it takes longer to sell houses. You could see we'll build this inventory on the backside. I brought this up last week on overpriced properties, because people are not going to want to stretch that much, especially once we get past the spring. Once we get into the latter half of June into July, for sure, that's where things are really going to slow down, and that's where we will continue to accumulate a lot of homes in the market. Properties that look like a dog, smell like a dog, that are a dog should be priced like a dog. When they're not priced like a dog, they will sit on the market. And properties with inferior locations like jumbo jets that fly over your house or backing up to a busy street. Those are homes that as this year progresses, they will be harder and harder to sell, and they will accumulate on the market. So if you have one of those properties, place that home on the market now. Now, as far as inventory is concerned, check this out. You can see where we're at right now. This is inventory over time. And this is from 2012 to today. And the highest that we got, we didn't even get to 50,000 homes on the market. And what unfortunately, what this does not take into account is what happened prior to 2012, which was the Great Recession. And that was the Himalayas of what I called a housing glut of homes available to sell. It was the peak of home sales. A number of homes in the market. It was way too many homes. And so if you look, and I'm putting them side by side to show you exactly where approximately Southern California's, because I only tracked a couple of markets, but from that I can extrapolate where Southern California's inventory most likely was during the Great Recession, about 2007. That's when Orange County alone had close to 20,000 homes on the market, and now they just surpassed 2,000 homes on the market. So if you see this is where Southern California had an inventory during the Great Recession, which I called a housing glut. We had way too many homes on the market, 120,000 homes on the market. Compare that to 43,000 is the average peak between 2019 prior to the pandemic. So 120,000 is like 3 times that amount. And where we are today in all of Southern California is at 17,500. You can see that is a gigantic gap to where we were when values were coming down at an alarming rate. And so we're not even close. We're not even close to where we were peak-wise prior to the pandemic, and we have a long way to go. So then there's a problem. Where are we going to get all of this missing ingredient? Where are we going to get all of these homes? The issue is that there is a new trend that has evolved, and we were already not placing enough homes on the market compared to the averages prior to COVID, during COVID. So for the year of 2020, we're missing 29,000 homes, 11%. In 2021, another 7%. We're missing 2,000 homes. But if you look at January to April, we're missing 15,000 homes. That's another 16%. Just in the first 4 months of 2022, almost as many homes as are missing in all of 2021. So you could see something new has started, and that is people are staying in their homes, not listing their homes. And I don't know that many people that are actually talking about this. They're talking about it with just conjecture, saying that people aren't going to sell their homes, but they really aren't going to sell their homes. And when you look at the actual data, rising home prices They know that their homes are rising. People are snapping photos of them and sending them, look at how much my home is worth. But it's real. They've seen their home values rise. They also know that mortgage rates are rising, and they love their fixed low rate, which means they're happy staying where they're at. They do not want to move because it's just going to be too expensive. They've got a very, very low rate right now. They don't want to double their rate or have a significantly higher rate. It just doesn't make sense. So as a result, you're not going to get any panic selling out there. I'd like to thank our sponsor again, and that is my buddy, your buddy, Kevin Buddy at Monarch Coast Financial. And of course, he deals with more than one kind of borrower, more than one kind of loan, and everything from full documentation loans to alternative documentation, investor financing, and private money. So he deals with it all. He even helped our family out, and he has loads of experience. He's been doing this since 1976. He can help your family out like he helped my family out and help your clients out. Contact Kevin Buddy at Monarch Coast Financial, my buddy, your buddy, Kevin Buddy, at 949-422-2075. That's 949-422-2075. And now I'm going to really quickly talk about demand. And demand, 2 weeks ago, when we looked at, or last week, when we looked at that 2-week period ending in April 28th, demand was actually shed 826 homes, down 5%. So you could see it really did slow down. It was the lowest level since tracking began in 2012. So I know that it isn't as low as during the Great Recession, but it was the lowest during the expansion time other than 2020 when we went into the pandemic. And last year at this time, we were at 19,575, which is 29% higher. 3-year average prior to COVID, 16% higher. That's 2,378. Extra pending sales, that's the 3-year average prior. So you can see demand is definitely muted, allowing inventory to rise, even though there are fewer homes coming on the market. Actually, today there's 15,350, so we had a slight increase in demand. So it's kind of like, we'll see if this sticks for the next couple of weeks. But if it did, it means it came down to that level, and now it's happy. It found its happy place until it gets slowly coming down until it gets to the fall. And then it'll go down a little bit further. But as far as inventory and demand, we now have more inventory than we have demand. Haven't had that in a long time. But in order for it to be a buyer's market, we have to have 61,000 homes in the market today, given today's demand, in order for it to slow down and become a slight buyer's market. It has to be even higher than that to be an actual deep buyer's market where we have values coming down a lot. And we're not even close to 61,000. We have 17,000 homes on the market. That's it. So you can see, missing ingredient, homes. How fast is this market moving? It's moving fast. 7 weeks ago, we were at 24 days. Last week, got 33 days. It went up 9 days in a very short period of time. Last year, we were at 24 days at this time period. And today, our 3-year average prior to COVID is at 64 days. And today we're at 34. So you can see it's gone up just slightly, from 33 days to 34 days. So it's slowly but surely slowing down. But understand that at 34 days, it is still an insane market. You can see it right here, insanity. I blew this up for you so you can understand that above 120 is where it just starts to be a buyer's market. It's a slight buyer's market. Above 150 is a deep market. We're nowhere close to that. Where we are today is below 40 days, which is an extremely insane market. We're going to finally make our way above insane, but we'll still be below 60, which is still hot, and values are still going up. So like I said, we're going to go from 20% appreciation to 5% appreciation. Hey, if you want a copy of this presentation, you need to be a subscriber to the Housing Report, and because they automatically get it. Go to reportsonhousing.com, click on subscribe, and we have them that all over Southern California, $15 per month or $150 per year. You get a first month is free if you sign up utilizing the coupon code PRICES. And get the most recent one. We'll email it to you. It's called Unexpected Slump in Demand. That's for LA, Orange County, and San Diego. Riverside and San Bernardino get next week. Well, that's all I have for everybody today on this debrief. So, fantastic. Finish your week. But I do have some friends that want to come and say hello to everybody. Don't I? Do I have some friends? Let's see. I think I've got friends. I can't get this to shut up. It's funny. It's like it's stuck. Hello there. You could say hello to everybody. because that's all we have for everybody. So say hello. Who are you? What's your name? What's that? Ezekiel. Where were you just right now? At school. Did you have fun? So anyway, say tell everybody to have a good day. Have a good day. That's kid number 1. Who's Mason? And everybody. All right. So I can't tell you what you're going to ask you what you're going to do this weekend. So
Homework.
Who do we have here?
But
you need to make sure that everyone sees you.
Yeah, I mean, I'm important. So
are you?
Exactly.
So important to say? All righty then. Good.
But I do know what I'm doing today.
What are you doing today?
I have soccer practice.
Oh, why? Wow, that's fun. Neat.
Why?
No,
Because
okay, have fun. And last but not least, Joe. How are you?
Good.
Convincing. Smile for the camera. All righty. What are you doing today?
Soccer practice.